And we're going to start off with a very interesting question and a great question from Brian. And Brian asks, he's taken a trade on 10-year T-notes in a bond product, and he just wants some pointers on it. And he's doing some testing on it. Right. First of all, great choice because the bond market is a very liquid market, very widely traded. There's a lot of liquidity. So it is a great market to use. Also, it's very steady. It's quite slow. So if you look here on the hourly chart, you see the way it moves? It's quite now on the 10-year T notes, bond from 110, right, up to 111 is so from here, 110 to 111 is $1,000. So 1/64th of a point, so 110.20 up to 110.21 is $15. So you can see it's quite slow moving. It's a much slower moving market than, say, the E-mini. And one contract size just gives you a little bit more wiggle room. Now, the difference between the two is this, is the 10-year T-note, and I know you know, this is for trading more macro news. So it's not got the same risk as equity risk. It's more on interest rate expectations. Now, this means that the 10-year T-notes tends to be less volatile than the equity market, but on calendar events, it can be really, really volatile, which is very interesting when you're saying that you know of someone who's fading these the 10-year T-notes on risk events. That's a very interesting strategy. That's a very interesting strategy because if you look here, you can see that that's a 130 new spike. You'll see that, here's another 130 news. You see that? See, it's quite calm, but then quite volatile on the news. All right. So a very, very interesting strategy, Brian. I think you're looking into a very interesting area there, and something that's definitely worth keeping your eye on. Fading that, I can see that. That's a sensible kind of approach. So definitely worth researching that further. And you could this could easily become a specialist market. The thing I like about it is how steady and slow it is. The trader just trades that, yeah. Yeah, and you can see, look, and it's quite a forgiving market. If 1 point is $1,000, so that's from 109 to 110, you've got all that wiggle room. That's not bad, is it at all? And then you can find trap buyers and sellers like you can in the E-mini. Exactly the same. It's not so technical as the E-mini, and it is best for macro fundamental traders. You're really trading interest rate expectations, things like that. That's what it's best for, and has less volatility intraday. Also good for trading interest rate risk and separate to equity risk. So I hope that's some pointers that's helpful for you, Brian. Yeah, but definitely worth looking at. And it's a very liquid market, so thumbs up in terms of the right thing. Yeah.